Should you be selling Pfizer shares and buying AbbVie instead for future share price growth as well as future dividend growth? We're going to take a look at Pfizer stock today. We're going to compare it to AbbVie. We're going to see which one is better for long term. We're going to look at their historical performance as well as both of their dividend safeties. We're going to take a look at their financial metrics to see which one is better positioned for the future. We're going to take a look and have a quick screener for buys and sells. As we can see, there is some activity, and we're going to take a quick look at past performance over the last few years to see which one has returned better total return for the investor, and we'll compare and see what institutions are favoring over the last year, whether or not they're actually preferring to buy AbbVie or Pfizer. And as always, we will take a look at the valuation of both of these companies to see which one is a better buy. We're going to look at the intrinsic value of both Pfizer and AbbVie. We're going to get to our acceptable buy price of each one given our investor margin of safety, and we'll look towards Wall Street to see what they are forecasting in terms of growth over the next year. So let's start off today and look at Pfizer. Firstly, they are down 37% over the last year. As you can see, they are pretty much at their 52-week low. They do offer a yield of 6.11%, and we can see their forward PE of just over 12. And when we take a look over the last 10 years, they are down 9%. Bear in mind, this doesn't include those dividends reinvested, and we can see their all-time high was sitting around $60 at the back end of 2021. Now, when we compare that to AbbVie, we can see they're in actual fact up 20% over the last year. And when we take a look at over the last 10 years, they're up 244%. In contrast to Pfizer, which is at its 52-week low, they sit towards their 52-week high. Their yield is lower, over 6% for Pfizer, 3.5% for AbbVie. And we can see the forward PE a little bit higher at 15.5. So let's take a look at the insider trades, whether there are any insider buys or sells. And what we can see here, looking at insider activity, as the great investor Peter Lynch said, insiders may sell their shares for any number of reasons, but they buy them for only one: they think the price will rise. So we have a bullish sign when looking at Pfizer. We do see in the middle of December last year that there was a buy, 3,000 shares by the director, just under 80,000. And we can see from then the share has gone up. We also know insider selling from the EVP Nicholas of AbbVie, and we can see he did sell around 450,000 shares, and the share price has gone up 13%. So I would say a bullish sign in terms of Pfizer, the director buying. In terms of AbbVie selling, I wouldn't really say that's any bearish signal. As said before, insider selling is for many reasons: personal, financial, and others. So let's take a look at their performance then over the last year to see how they've performed. We see Pfizer down 34% on a total return basis, AbbVie up 25%. When we extend that to the last 5 years, we do see that AbbVie is up 176%, whereas Pfizer down 15%. Bear in mind though, as we always say, past performance isn't an indicator for future performance. Now, when we compare the institutional buys, now we can see for Pfizer institutional ownership at 68%, 11 billion worth of sales by these institutions over the last 12 months. In terms of buys, a lot of buying over the same period, 96 billion. So institutions clearly do like Pfizer. We see a huge buy in Q2 of 2023. In contrast, when we look at AbbVie, pretty much similar institutional ownership, both around the 68% mark. Yes, there has been institutional sales, 11 billion over the period, but there is also buys, a lot more at 30 billion, but in comparison to Pfizer, there is a significant amount of institutions buying these shares. So overall, we can say that the institutions, whilst they are buying more than selling of both Pfizer and AbbVie, they have been buying a lot more Pfizer shares for their portfolio. Now let's take a deep dive into their dividend safety. With Pfizer, we have a score of 75. It does look to be safe. Market cap 155 billion. They are a mega cap company. Now, in terms of those key recessionary metrics, for those that see a recession inbound, well, they did cut the dividend during the last recession, 07-09. They had above average growth, -6% versus the S&P's -12. And they also outperformed the S&P -45 versus the S&P's -55. Now, they increased the dividend in December last year, 2.4%, below that 4% we want to target every year just to keep up in line with inflation. Better news though, 4% on the last 5 years, 5% over the last 20 years is a good sign. and we can see they have been increasing those dividends for the last 13 years. In terms of dividend yield theory, well, as always, it states the company is undervalued when the current yield sits above the 5-year average. 6.13 versus 3.92, we have our first sign of undervaluation. Forward PE 12.2, pretty much bang in line with the 5-year average, and we do note the healthcare sector PE is much higher at 17.6. So let's talk about the free cash flow payout. As always, earnings data is available for all investors. However, note we ignore it. It is susceptible to manipulation by management through accounting. We prefer to draw your attention onto the free cash flow payout. Now, it has been pretty decent. Whilst we like to see below 60% for the majority of companies, for the large part it has been below. Massive red flag indicator both in 23 and 2024. The reason for this, and is why we look at the free cash flow as opposed to the earnings, it shows us that management are expecting in both 2023 when the annual report is delivered, as well as 2024, that they're going to pay out more in dividends than they generate in free cash flow. So something just to bear in mind. Free cash flow per share we can see pretty stagnant up to 2020 around the pre-pandemic point. After that it did increase, but we can see both 23 and 24 back in line with the stable free cash flow per share that we saw prior to COVID. Sales growth again after COVID down 42%, a bit of a worry. Hopefully Pfizer will have a lot of interesting things in the pipeline to generate more revenue, but also understand that they are looking to do acquisitional growth as opposed to organic. Before that, or in fact during the COVID pandemic, their top line soared massively. Before that, pretty poor. And when we look at it numerically, we see it's gone from 50 billion in 2014 to just under 60 in 2023. Now, they have done share buybacks. They have returned excess cash to investor pockets by buying back shares, dropping it from 6.42 billion to 5.71. Now, in terms of the ROIC, this metric's one of my most important. I want to see 10% or more. It gives me faith management are able to effectively allocate their capital. 2023 at 3%, very poor, yes. Prior to that, it looked very strong, but I do want to see this go significantly higher before I'd even consider investing myself. Free cash flow margin then, very nice to see, well above the minimum 5%. It did drop in 2023, and a similar story we can see on the operating margin. 2023 wasn't a particularly good year for Pfizer, so something just to take a look at management's forward guidance and quarter on quarter ensure they are going back up to the levels we have seen prior. Net debt to earnings before interest, tax, depreciation, amortization. As always, it signals the balance sheet strength as well as dividend safety. What we're looking for is below 3, with these are the number of years it would take the company to pay off all of their debt net of cash on hand. Nice to see it's 1.75 in 2023, below 3. 2024 expected to go to 1. So realistically, no issues there with the dividend. The balance sheet does look strong as well. Now, before we jump into the valuation, let's look at the same exact metrics for AbbVie. Dividend safety score 70, market cap 306 billion, a mega cap company as well. Recessionary metrics, well, they didn't pay a dividend during that period, but they did have plus 10% above average growth. Now, dividend growth, a much better story than Pfizer, above inflation in October last year, 4.7%, 9% on average over the last 5 years, strong double digit over the last 10 years. Now, they are a dividend king as well. They have been increasing those dividends for 50 years or more. So when we take a look at dividend yield theory, we actually see a sign of overvaluation with the yield above the 5-year average, as well as the forward PE above the 5-year average too. Now, sector PE 17.6 for healthcare, AbbVie is under at 15.6, so interesting to note that. And when we take a look at the free cash flow payout, pretty much other than 2014, very consistently below 60%, which is nice to see. 42 in 2022, expected slightly higher in 2023 at 42%. In fact, expected the same in 2023, a little bit higher in 2024. So, free cash flow per share, very nice to see. Probably one of the few companies that we have reviewed on the channel that does increase it fairly consistently year on year. And we note $14 expected in 2023. Although I do have to point out in 2024 it is expecting to be lower at 11.5. Sales growth, wow, I mean, pretty much double digit nearly every single year. We do see 1 or 2 years with single digit growth. 2023, though, a drop to the top line of negative 6%. And if you do want an in-depth review of AbbVie, we can run through that, talking about their pipeline, their exclusivity loss in another episode. Total sales then, 20 billion, more than double their top line over the period, 54.3 in 2023. Unlike Pfizer, whilst they do share buybacks, the net position over the last 10 years would be share dilution, diluting your position as a shareholder. 1.61 billion in 2014, 1.77 in 2023. ROIC, much better than Pfizer, well above the minimum 10% I personally look for, and some people do extend this to 25% for biotech companies. Well, the last 3 years have been in the mid-20s, so that is nice to see. And when we look at the margins, very strong, both operating as well as free cash flow. In fact, the free cash flow margin has been increasing over the last 10 years, a very good sign for any investor. And when we look at the net debt to EBITDA, probably something just to keep an eye on. 1.82 in 2023, it is expected to be pretty much the same in 2024. So yes, it is above 1.5, but just keep an eye on. So far, based on the information and that free cash flow payout, the dividend does look to be safe. So we've had a look at the metrics. Now let's get into the valuation. We'll start off with Pfizer, and as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do run through every single one of these models, but for today's episode, let's jump straight into the calculation. Intrinsic value arrives at $36. Don't forget you can grab a copy of the intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio and in your watch list. So we start off usually with a margin of safety of 10%, which we use if we believe the company has a wide moat, strong financial metrics, good forward-looking data. 10%, it is a buy up to $32 if you are satisfied with that margin. 15%, $31, and we keep going until it's roughly near the current trading price. So we see right now, we see a 20 to 25% margin of safety. Now, in terms of Wall Street and what they forecast, well, they have 17% upside over the next 12 months for Pfizer with a price target of $17. We then move on to AbbVie stock analysis to do the exact same to get to the intrinsic value. And for today's episode, we get an intrinsic value of $174. So in terms of the current price, it sits around 175. Margin of safety then, realistically, there is no margin. We do believe it is currently trading at its intrinsic value. In terms of Wall Street, well, they see upside of 1%, so they as well do not believe it is too far off its intrinsic value, considering it a hold rather than a buy, whereas when you look at Pfizer and the upside, they see that more as a buy, which the institutions themselves have been doing, as well as insiders. Now, overall, my thoughts about whether or not to sell. In terms of my own position, I do not hold any position in Pfizer. I do hold a position in AbbVie. And whilst the valuation isn't quite there yet for me personally to add more shares of AbbVie, this is definitely one I would be adding as opposed to Pfizer. Right now, if I had to choose one, even though AbbVie is trading at a more expensive valuation with no margin of safety, it is one that I would be looking to add for the future. Given the financial metrics, it does look like it is operating a lot more efficiently, has a lot more stronger metrics, and the forward guidance didn't look bad either. Whereas with Pfizer, there are a lot of red flag indicators that we ran through, especially when you do look at that dividend. There could be a potential case for a dividend cut, given that free cash flow both for 2023 and 2024 is expected to be over 100%. Now, different people will have different reasons for choosing either. Some may even pick both. So let me know your thoughts in the comments below. Let me know if you like this type of episode, if there were any others that you wanted to square off to see which ones look better. As always, have a great day. If you enjoyed the episode, smash that like button, hit the subscribe and bell so you are notified of these beautiful videos. And as always, we'll see you on the next one. Take care for now.